It's nice having you today as we discuss a lot that's going on with the markets. Now, there is a lot that has really happened over the last number of weeks regarding inflation. I know this is something that we've been talking about over and over with respect to all the different aspects of it, but that's just it. There's a lot to discuss, and it's going to actually dictate the policies and the way forward on the economy from here. Let's kick it off with number one, economic and stock market risks. You may have heard whispers about us returning to a 1970s style inflation. Well, let me tell you right now, that is not true. We are nowhere near the 1970s because many things are different today than they were back then. So the first thing that is different is our spending of the US government and the ways that we are deficit spending, which is not the same today as it was back then. See, right now today we are actually spending more than where we were back in the 70s, and unemployment, really, if it equated to where we're at with a deficit spending, would be closer to 9 to 12%. So yes, you heard that right. That at the peak of all of the great financial crisis that happened back in about 2008, 2009, that's where we'd be today with the amount of spending that we're doing. So it's a huge change that's going on. So yes, we're not going back to the 70s on that alone. But then there's more aspects here that becomes a little more complex of what we need to be considering with some of the global trends, all these global things that are going on. You see, right now, the US has really had a disastrous amount of debt that we've really started to accumulate since the last couple of years. But it's also been since the 1970s that we've started to really start to produce some stagflation as well. So when we take a look back then, the GDP was double where it was now. And inflation, while yes, it was a red flag, was completely different than what it is today. You see, when we take a look at GDP today, it's between 1 and 2%, so a lot lower. And what that means then is that the deficit spending that we need to do has to be a lot more in order to help sustain and fund the government, but that also could help to increase and keep inflation sticky high as well. So what cures this? What cures inflation? Well, wars are inflationary, and we have some wars going on right now, same as back in the 70s, so that's no different. But really, ironically, the one aspect that cures inflation faster than everything else, recession. Now, yes, I'm not saying that we're going into a recession here, but what I am saying is that there's a lot that we are starting to see of inflation starting to become entrenched, and that the households, especially the lower ones that are struggling to survive just on a day-by-day basis, are really starting to struggle, especially to pay credit cards, their mortgages, their rent, cars, and that all is what really worries us. So when we take a look at that then, stagflation is really the name of what we could be coming into here for the remainder of the year. Now yes, we have been talking about this lead to type of environment where we have growth of the economy and growth of inflation, but the economy is starting to slow and is going to actually slow a little bit more coming into the end of the year. So that really gives way for this stagnant environment. But that's not all bad though. Like I said, many companies actually can do very well in this environment. So when we're taking a look at that, in all of the different inflation aspects out there, we know that there's going to be a lot that the Federal Reserve is going to try to do to tamper it down. But when we take a look at some of the things that are working, like all the copper miners, gold miners, a lot of the different, energy sectors and different aspects that are inflationary, that grow with inflation, well, those are areas that we've actually seen starting to work in the last number of months. So yes, we see inflation starting to increase from here. We definitely see that going more towards 3.75% towards the end of the year. And then we may even see a little more continuation into next year. Not good news. But that doesn't mean that it's going to necessarily hurt our economy. And it's all about how the Federal Reserve is working with that. And right now, they're actually signaling they may want to put inflation in their fight on inflation on hold while they focus on making sure that employment matches their objectives. So, if that's the case, embrace it, and we can be investing into areas that will grow with inflation. Number 2, portfolio changes. While there are some times that I do come in and say we are not making any changes, today is not one of those days. You see, what we're doing now is really starting to look really heavily into the things that are inflationary, like we've already been doing. So the items with respect to gold tend to do well in this type of environment of stagflation. We see the miners, whether it's gold, silver, copper, all of those tending to do well. Sometimes we see oil and some of the energy plays starting to do well. But here's the thing. When we start to look at other areas around the world, we start to see they're not in this environment of just stagflation. They're in an environment of growth. And that's where we are starting to really see some changes with Europe and with emerging markets. So those are some of the elements that we've been talking about recently that we've been adding into the portfolios, and that is continuing now. So yes, we can be looking to fight inflation here, but we can also be looking at placing money into those countries that are growing and ones that actually are in a low inflationary, high growth aspect. And like I said before, a lot of Europe is coming out of a recession in that manner and could very well be set up for growth. Number 3, wealth management and advanced planning. There's a lot that we have talked about over the last number of weeks with respect to taxes, but one of them I really want to lay out comes back down to stocks. You see, when you go to sell a stock, there actually may be a net investment income tax on top of the capital gains. So this could be 3.8% on top of your already either 15 or 20% capital gains rates. And so there's a couple ways we can avoid this if needed. First one then we could come back to is a charitable lead trust. Now this is a great tool that can be used if you're charitably inclined to gift the tax into the charitable trust, support the causes that you care about, while providing them an annuity that can actually be sustaining them, but you may actually get a little bit of cash back in the future without the tax burden. And oh yes, you do get the tax benefits that come with charitable donations as well. So this could actually be a very good way to, have your cake and eat it too when it comes to charity. Now, that's not the only one that we can do. We can also be grouping some of your business activities and the material participation that you do, and that could actually avoid some net investment income tax. So now we are finding some other ways then that we could actually have material participation and actually avoid the net investment income tax. And this is really for certain things like some of the rentals or other activities that you have that may be passive. So there are other ways that we could be looking at this, but it really comes back down to understanding, do you have passive income or active income with respect to businesses? And would this actually be beneficial to start grouping some of those businesses together? Well, that's a topic for your tax attorney, but it's also one worth considering. Now, there's some other elements that we can do that may not be more of a business related, but we can actually change some of your filing statuses as well. And now what this would do is classify some of the dividends, the interest, the capital gains that maybe you're paying on a married filing jointly tax return, and we could actually take it and really start to change things around. So maybe that means that we're married filing single, and maybe that means that there's some other elements that we could be considering here for tax exemptions or even some tax deferrals that could lower our overall capital gains. And when we start looking at it that way, we can actually push off some of those gains maybe until next year, and that alone could actually really benefit some of the net investment income tax and the reduction of that as well. Well, There's many other strategies that we can be employing here, like some estate planning aspects that we could be doing for gifting. We could be doing some risk management. We can be doing some legacy planning. But all of that comes back down to your wishes and your needs. That's why taking a little time to take a look at where you're at today and looking at the net investment income tax for selling is crucial. Speaking of which, I want to talk about our second opinion service. As we're talking about looking at where you're at today, you may actually have some friends, neighbors, colleagues who are actually thinking about the exact same thing. They want a stress test or a second opinion on their wealth plan to see where they're at today, where they want to go in the future, and if there's any gaps that exist. And that's what this does. Offers you the ability to have others really go through that second opinion service. We take a look at all of that and really determine if there are any changes that are needed given today's environment and regarding taxes. So with it, if you or someone you know would like to go through a second opinion, please click the link below. You will add in your contact information and we will be happy to set up a time to meet. With that, take care.